Hello. We talked about most steps of the accounting cycle, and the remaining are preparing the financial statements and closing the books, which we will talk about today. Don't forget that we have a practice example at the end of this video, so stay with me. But before I get started, I have to tell you that I will explain each financial statement in a separate video. But wait, if you are new to my channel, give me a like and subscribe and leave a comment. Are you ready? Let's begin. Step number 8. Create financial statements. This step of the process is pretty straightforward because you already have needed data in the adjusted trial balance. All that's left to do is transfer it. There are 4 main financial statements. First comes the income statement, which include 2 accounts, revenue and expenses. Its purpose is to show how much profit the business has generated. From that answer, you then evaluate how well your business is performed in the accounting period. After finding the net income of the business, the next step is preparing the retained earnings statement. This statement reconciles the beginning and ending retained earnings for the period, using information such as net income and dividends. The third document is balance sheet, where you display assets, liabilities, and equity. It tells you whether or not the business has enough assets to meet its duties. We have another statement that's called the statement of cash flow. This document presents the business inflows and outflows of cash. It divides the money based on the 3 main activities, where it comes from: operating, investing, and financing. We will talk about it in another video. If you want to talk about our example in the previous video, we can see here an adjusted trial balance. Here we can see all revenues and expenses accounts, which are transferred into the income statement. Retained earnings and dividends will be transferred to the retained earnings statement. The retained earnings at the end of the period will be transferred to the balance sheet. Here we can see all assets, liabilities, and equity accounts, which will be transferred into the balance sheet. Still a bit unclear? Don't worry, we have an example at the end of this video. Let's move to step number 9, closing the books. We make this process to reduce the balance of the nominal temporary accounts to 0 to prepare the accounts for the next period's transactions. Transfer all income statement account balances into retained earnings account in owner's equity. Balance sheet accounts, assets, liabilities, and equity are not closed. Dividends are closed directly to the retained earnings accounts. For our example, we have to close all revenues and expenses accounts in the income summary. We can see here the first entry, debit service revenue, credit income summary for $106,000. And the second is debit income summary, credit supplies expense, depreciation expense, insurance expense, salaries and wages expense, rent expense, interest expense, bad debt expense, to close expense accounts. The income summary will be closed in the retained earnings, and the entry is debit income summary, credit retained earnings, and the dividends also, and the entry is debit retained earnings, credit dividends. Let's move to the example. Here we have an adjusted trial balance for Nalizy Advertising Agency on December 31. And we have to prepare income statement and the balance sheet for this corporation. Here we can see all revenues and expenses accounts. They will be transferred into the income statement. The first is advertising revenue, and the expenses, salaries and wages expense, depreciation expense, supplies expense, and rent expense. After deducting expenses from revenue, we get net income. Here we have assets, liabilities, and equity accounts. Let's begin with cash, accounts receivable, supplies, equipment, less accumulated depreciation equipment in the assets, accounts payable, unearned advertising revenue, and salaries and wages payable are in liabilities, common stock in stockholders' equity, and we have retained earning. The balance of retained earnings at the end of the period is the balance of the retained earnings at the beginning of the period, after adding the net income and subtracting the dividends if any. Here we have retained earnings at January 1, $4,800. Add net income, $35,800. Retained earnings at December 31 will be $40,600. We can see here in the balance sheet, and after all of that, we have to sum assets and liabilities and stockholders' equity. That's all for today. See you next video.